Hi and welcome to this video on supply and demand zone trading. Now I'm going to be covering a few topics. First is obviously supply and demand introduction, the psychology behind supply and demand and identifying value on a price chart, supply and demand candlestick zones and how to draw supply and demand zones using candlesticks, trading supply and demand candlestick zones, odds enhancers and the difference between supply and demand and support and resistance, and some others as well. Now, an introduction into supply and demand is really the more demand and supply, prices move higher, and the more supply than demand, prices move lower. Pretty basic stuff. But in Forex, demand is represented by buy orders and supply is represented as sell orders. So when you press a buy order when you're broker, that is demand, and when you're pressing a sell order or taking profit, which is a sell order if you're buying, that is supply. So increases and decreases are determined in supply and demand, determined by perceived value, right? And value is derived by really fundamental analysis as well as sentiment. Now, supply and demand levels identify potential areas on a price chart. Yeah. So before I get into my methodology on supply and demand, I just want to go over what a lot of other if you do a search on supply and demand, what you'll find online. Now, you'll find something along the lines of this kind of, sorry about that. You'll find something like rally-based drop and drop-based rally. So you'll find rally, and then you'll find a base, and then a drop, and then this would be considered a level of supply. Or you'll find a drop, a base, and a rally, and this will be a level of demand. Sorry about my crude drawing. And if prices ever come back to this zone, then you should look to buy. And it basically, they traders who trade support and resistance, or supply and demand, I should say, don't necessarily understand the whys behind drop-based rallies and rally-based drops. And I'm not going to necessarily be talking about drop-based rallies, rally-based rallies, etc., and drop-based drops in those terms. I'm going to be giving it to you in really the simplest and best way, and also I'm going to be giving you the reasons, because supply and demand, what traders fail to mention is that supply and demand really is just is tied to value. Right? Traders are not going to buy and sell at areas unless they feel that it's either a bargain or it's expensive. It's as simple as. So I'm going to show you exactly the methodology behind and the psychology behind supply and demand as it should be traded. So when we look at demand, we need to understand that we are looking at a price chart in hindsight, obviously, right? And the further price moves, right, away from the origin, let's say, for example, this is the absolute low and this is the absolute high. The further price goes, obviously, we have stronger demand, but also the area at the source of the demand is seen as cheap or a bargain price. And we know this to be true because if you know that you're buying something at value, you're gonna basically load up on whatever it is that you're buying, right? And especially if you know that you can potentially double or triple, quadruple your investment or your money or your trade. Let's say, for example, this represents a 5 or potentially a 6 to 1, 7 to 1, or whatever it is. You're going to load up on value, right? So, and this is evident from, basically just looking back in the past. This has to be an area of value at some point. Doesn't mean that it'll be an area of value in the future, but we know this to be true because this is what has happened. This is what the evidence has shown, right? Now, if it wasn't true, then this would be probably, the demand. So we would have, you can say that this is basically not strong demand. buyers are not buying in and loading up and buying in mass, because you can see that the line and the steepness of the line is very, very shallow. So what you need to see really is, price needs to basically look like it is going is quite steep, and we know that this is strong demand, and it has to go as well the distance. So we're looking at the angle and the distance that tells us that the demand is strong at the level. So when prices do come to a level, what is usually taught when it retraces is that now the bears or supply has taken over, which is not true. What is happening at a level is, if we don't know what's going on to the left of it, you can never take or you should never take a retracement as a sign that there is strong supply. Take it as this is profit taking and there is less demand. So traders, if this is a cheap area, right, and look at this area as the fact that buyers are no longer entering the market and therefore demand is decreasing. Doesn't mean that supply is increasing and supply is now taking over and the bears are taking over. It just means that this is potentially a price area, because traders tend to disregard price, right, when it comes to trading. You should always take into account what price level we're at, and if we've been going up for a certain amount of time, this is where the smart money buys, and this is where losing traders buy, right? They tend to look back on the past, and then they will actually buy at the highs, and the smart money is obviously buying at the lows, right? So smart money is not buying at highs. They are actually taking profit at highs. So if they're looking to take profit at highs or potential highs, then it just means that this retracement is as a result of less demand coming in, because this is considered a take profit area and potentially an expensive area on a price chart, right? Because buyers are no longer willing to buy the asset at this price, right? So I put here strong supply or weak demand. In my opinion, it's weak demand on the first touch and first retracement at a price level, and not the fact that there is going to be strong supply coming in, and this represents really a potentially expensive area simply because buyers are no longer willing to buy at this level. So this would be considered cheap down here, and this would be considered expensive. Now, when we get a retracement back into this zone, or if we get a retracement back into this zone, right, into what we would consider a previously expensive area, if we get a reaction at this area and prices fail to move higher, then this is considered now an expensive area. And we know this to be true because buyers, there's no more buying, there's no more demand coming in at this price to push prices past this level, right? So we know this to be cheap, this to be an expensive level. So what happens between a cheap and an expensive level? If prices then come back down to this demand zone, right, this once considered cheap demand zone. So imagine you were you had bought down here, you were smart money, sold up here, made some profit. If you had a chance to buy the same asset again and knew the value's worth, the value of that asset that you bought and made some money on, would you not try to buy again at this area? Of course, but this is only if you understand the potential value of what you're buying. You're pretty much buying again at the cheapest and bargain value price when prices come back down to a low. And this is what is meant by buy low and sell high. So this is always going to be the best value, right? If you're looking at a low to a high, buying at the lows and selling at the highs is what you want to do. And in between an area that is considered expensive and an area that is considered cheap is known as fair value. Now, let's go back. Now, imagine we have prices come back to this, what is known as a potentially expensive area, right? Because we don't know at the moment whether demand and buyers are going to consider this a level of an expensive area, and if they're willing to really buy and push prices past this expensive area. And if they do, right, then this area is obviously no longer considered expensive, right? The buyers who bought around here and pushed price up to what was considered an expensive area continued buying. There was still demand. There were still traders coming in, buyers coming in. Demand was still increasing. So you can't say that this is now an expensive area if we make new highs. Now, where the source of the move higher goes, exactly like where we had down here, we have basically a higher low, and this now becomes a strong area of demand, or the strongest area of demand when it comes to this move higher, right? Because again, with the same principle down here, buyers saw the value of the asset that was being bought, so much so that when prices came up to what we would consider a potential expensive area, buyers were still piling in. There was still a lot of demand for the asset. So this again becomes a cheap area, a potentially cheap area, in exactly the same way that the source of this move from the low to the high becomes a bargain price and a cheap area. So lows and higher lows in an uptrend are the areas that you want to look for on a price chart when it comes to searching for demand and identifying demand on a price chart. Now, we also have potentially a new value range, right? Whereas in this slide, this would have been the value range had price been contained between the low and the high, right? Because buyers and sellers are really in agreement between what is cheap and what is expensive. Now, every higher low and higher high that is made, we potentially now enter a new value range, right? So the new value range will be between this higher low and this higher high, as we if prices do stay within this range, right? So what we have is halfway between this range will be considered fair value, and if prices do come back down to this area, this would be the area that we would be looking to buy. This would be the strongest area, or one of the strongest areas of demand at a higher low. And again, just understanding the psychology of why this would potentially be a strong area of demand and why we would want to buy again in the future is because traders, the smart money, saw this as an area of value in the recent past. And understanding, again, this goes back to fundamentals and potentially sentiment, and having those factors on your side. When prices do come down back to this area, this is the first area we want to buy, anywhere below fair value, right? But this is definitely the strongest and potential area of demand, and this is where we would look for potential price action on a price chart and look for an entry if that's how you enter, right? So again, if we look at the logic from the opposite side, if prices didn't make a new high, let's say for example there was buying here and we got a bit of buying, but then we couldn't get a new high, then this automatically tells you that demand is weak, right? There's not enough buyers buying to push prices past a considered potentially expensive area, right? So again, going back to the logic, if we make new highs This is potentially an expensive area. We don't know for sure, but we know that the logic, if prices make a new high, that this would be the strongest area of demand. So with supply, it works in the opposite to demand, but it also depends on whether you're buying the base currency or the quote currency. But if we were looking to short the base currency, then this is exactly what it would look like, where you would have supply would represent an expensive or overvalued level. Traders looking to short. We come down to a level, and this is considered a potentially cheap level if prices cannot break past this potentially cheap level. When prices move back up and come down, if prices break through this potential cheap level, then this becomes an area of strong supply, and this is considered an expensive or overvalued level, right? So again, we go through the same process. We reach a low. This would be undervalued or a cheap area until proven otherwise. And if we come back up into the strongest area of supply, which is the source of the move that broke what would have been considered a cheap area. So obviously this isn't cheap anymore, or the cheapest area, because traders were still willing to sell and willing to dump and get rid of what it is that they're, the base currency, and short the base currency. Then this becomes the strongest area of supply. And again, do we have a potential overvaluation again when we come back up into this zone? And again, between an undervalued area or a cheap area, or an overvalued area or an expensive area, we have a value range. When markets go in a range and they're no longer making higher highs and higher lows, and they're chopping, it's because buyers and sellers are in agreement between the valuation and what they're prepared to pay for an asset or assets. In this case, obviously Forex. They agree that let's say for example the euro versus the dollar is worth between maybe 1.5 and 1.0 euros, for example, to the dollar. So it works in exactly the same way when we're talking about supply.